In this module, we are going to analyze the effect of monetary policy in ISLM model. The level of output is an important indicator of economic growth in an economy. The ISLM model determines the equilibrium output simultaneously in goods and assets market. IS curve represents the good market, while the LM curve is the reflection of equilibrium in the assets market. The monetary policy, which is related to the level of money supply in the economy, shifts the LM curve and causes disequilibrium, which is then corrected by the movement in the interest rate and income level. The monetary policy is used to raise the level of income in the economy and to stabilize the price level. As prices are assumed to be constant in the ISLM model, monetary policy seeks to work on the output and income. The process by which monetary shocks leads to the expansion of aggregate demand is called the monetary transmission mechanism. There are two broad steps involved in this process. The first occurs when changes in money supply results in the portfolio disequilibrium, and in the other step, changes in the interest rate due to portfolio adjustment affect the aggregate demand and output. The monetary policy multiplier shows by how much equilibrium income changes as a result of the change in money supply. There are many factors on which the effectiveness of monetary policy in achieving the desired goal depends, like slope of IS curve, bank lending behavior, slope of LM curve, etc. Let us analyze in detail the monetary policy in the ISLM model. Let us begin with ISLM model. The ISLM model is used to determine the level of output in an economy. The level of output is one of the most important indicators of the economic well-being of a country. This model brings together the goods and money markets to establish simultaneous equilibrium in both. The goods market is at equilibrium when investments equal savings, hence IS, and the money market is at equilibrium when the demand for money, that is liquidity, equals the money supply, hence LM. At the intersection of IS and LM curves, equilibrium, interest rate and income level are determined. A disequilibrium occurs whenever any of these two curves shifts due to change in exogenous variables like autonomous expenditure, including fiscal policy, and real money supply, that is monetary policy. The changes in fiscal policy shift the IS curve, while LM curve is shifted by changes in the monetary policy. This disequilibrium is eliminated by appropriate adjustment in income and interest rate. Money market adjusts relatively rapidly than the goods market. This is because the money market can adjust merely through the buying and selling of bonds. The interest rate adjusts rapidly and money market effectively is always in equilibrium. This assumption implies that when we are on the LM curve, any departure from the equilibrium in the money market is almost instantaneously eliminated by an appropriate change in the interest rate. The goods market, on the other hand, adjusts relatively slowly because firms have to change their production schedules, which takes time. The ISLM model with equilibrium in goods and money market at equilibrium interest rate and income is shown in figure. Moving on to meaning and objectives of monetary policy. Monetary policy is devised by the monetary authority of a country with the aim to control the supply of money using the various quantitative and qualitative monetary instruments. Monetary policy often targets a specific rate of inflation to ensure price stability and general trust in the currency. The major goals of a monetary policy, apart from maintaining price stability, are to contribute to economic growth and stability, to lower unemployment, and to maintain predictable exchange rates with other currencies. By altering the money supply using monetary policy, policy makers manipulate the base money, which are then transmitted into a broader money supply via the money multiplier mechanisms. An expansionary monetary policy increases the total supply of money in the economy more rapidly than usual and aims to raise the level of income and output in the economy. The expansionary policy is generally used to try to combat unemployment in a recession by lowering the interest rates in the hope to ease the credit expansion, which in turn will entice the business expansion. The contractionary policy, on the other hand, expands the money supply more slowly than usual or even shrinks it to control the inflationary pressures in the economy due to higher income. So, it is intended to slow down the inflation in order to avoid the resulting distortions and deterioration of asset values. Now, let us see the effect of monetary policy in ISLM model. LM curve shows all combinations of interest rate and income such that people hold the desired portfolio and there is no excess demand or excess supply for any other asset. In the derivation of LM schedule, it is assumed that the supply of money is exogenously determined by the monetary authority. But in reality, central bank has little control over the money supply and it conducts monetary policy principally via its capacity to set the short-term interest rate. However, in the ISLM approach, we keep on assuming that the money supply is exogenous and under the control of the central bank. Whenever central bank increases money supply, it shifts the supply of money curve. With the given demand for money and income level, it leads to a rise in interest rate leading to the shift of LM curve. Monetary policy changes are thus represented in the ISLM framework by shifts in the LM curve. Now, we will see the effect of monetary expansion in ISLM model. Let us suppose that money market is in equilibrium and the monetary authority changes the money supply by raising the nominal money balances M. The impact of this change in supply of money is illustrated in panel A of figure. The initial equilibrium in the economy is at point E0 where M by P is equals to L0 and rate of interest is R0. In panel B, the point corresponding to E0 is recorded as point A where interest rate is R0 and income at Y0. An increase in the money supply when nominal balances increase shifts the supply curve for money rightwards from M by P to M dash by P as shown in panel A. At the original interest rate R0 or equilibrium point E0, there is excess money supply which induces people not to hold newly supplied money. Rather, they would prefer to hold non-money assets. In this process, the asset prices rise and their yield, that is interest rate, falls. To restore equilibrium in money market, at the income level Y0, the interest rate declines from R0 to R1. This is shown by the shift in the LM curve with the lower interest rate at the same level of income Y0. So, the rapid interest rate adjustment causes the money market equilibrium to establish again immediately at E1. The point corresponding to this new equilibrium is point B at interest R1 and income Y0. However, at this point, goods market is not in equilibrium. There is an excess demand for goods at point B in panel B of figure. At point B, lower interest rate stimulates investment. Increase in investment causes aggregate spending and income to rise. Increasing aggregate demand causes inventories to run down and output to rise. The economy starts moving up along the LM dash. This is because, thus, the expansionary monetary policy in the ISLM framework causes a sharp fall in interest rate, which is then reversed up to that level where the goods and money market again reach a simultaneous equilibrium and income level rises. The same process will work in reverse if the monetary authority adopts a monetary contraction by lowering the money supply in the economy. Coming on to the concept of monetary transmission mechanism. Monetary transmission mechanism describes the process by which policy-induced changes in the nominal money stock or the short-term nominal interest rate impact real variables such as aggregate output and employment. The monetary policy transmission mechanism explains in steps how monetary policy affects aggregate demand. The transmission mechanism is characterized by long, variable, and uncertain time lags. Thus, it is difficult to predict the precise effect of monetary policy actions on the economy and price level. In the ISLM framework, we assume prices to remain constant and all adjustment will be through changes in interest rate and income. The monetary transmission mechanism in the ISLM can be explained through the following steps. First, change in money supply. Second, portfolio disequilibrium. Third, aggregate spending adjust to change in interest rate. Fourth, output adjust to change in aggregate spending. Beginning with change in money supply. The monetary policy is initiated when the monetary authority, that is central bank, changes the supply of money in the economy. Next is portfolio disequilibrium. The change in real money supply generates portfolio disequilibrium. Now, in the money market, people are not holding the desired portfolio. At the prevailing interest rate and level of income, people do not hold the desired money stock. People adjust their portfolio holdings by shifting wealth from money to other assets. This portfolio adjustment leads to the change in asset prices and their yields. Next is aggregate spending adjust to the changes in interest rate. Investment responds to the changes in the interest rates. A fall in interest rate induces more investment and vice versa. As investment changes, it alters the aggregate spending in the economy. Thus, changes in interest rate change spending through investment. Finally, output adjusts to the changes in aggregate spending. As aggregate spending changes, it leads to adjustment in the output levels being produced in the economy. Output adjustment is equivalent to change in income. Thus, we can say that if the central bank increases the money supply, the interest rate falls at the current national income level. This is because at the existing interest rate, there is an excess supply of money and the interest rate has to fall to stimulate an increased demand for money. The interest rate continues to fall until the demand for money is again equal to the increased money supply and money market equilibrium is restored back. In terms of the LM curve, this means that at higher levels of money supply, equilibrium interest rates will be lower at each income level, which translates into a shift outwards in the LM curve. This also involves adjustment in the goods market as we are talking about the effects of monetary policy in ISLM framework. The adjustment occurs in the form of upward movement along the new LM curve which causes a rise in interest rate and income level. Let us see the working of monetary policy multiplier in the ISLM framework. In the ISLM model, the effects of monetary policy on the level of income is assessed by using the equilibrium income equation, which is y naught is equals to gamma into A bar plus gamma into B into M by H into P, bracket close, and the monetary policy coefficient in the form monetary multiplier. The monetary policy multiplier shows the effects of changes in real money supply on the equilibrium level of income, keeping the fiscal policy unchanged. When there is an increase in the real money supply, the income will rise by the amount of monetary policy multiplier. Change in y naught divided by change in m by p is equals to gamma into b by h, where gamma is equals to h into alpha g divided by h plus k into b into alpha g, where b is equals to interest rate sensitivity of investment, h is the interest rate sensitivity of demand for money, and k is the income sensitivity of demand for money. The monetary policy multiplier implies that the expansionary effect of an increase in real money supply on the economy will be higher when we have large values of B and alpha G. Also, as gamma is equals to H into alpha G divided by H plus K into B into alpha G, smaller h and k will lead to higher increase in income level. If the interest rate sensitivity, that is H, for real balances is lower, that is almost zero, then gamma would also be zero, and in such a case LM curve will be vertical. On the other hand, if H is very high, that is almost infinity, then this corresponds to a horizontal LM curve. A high value of K, that is income sensitivity of demand for money, would mean a lower gamma, because in this case large increase in interest rate is required to maintain money market equilibrium, as demand for money is too responsive to income. The monetary policy has various objectives such as establishing price stability, maintain economic growth, exchange rate stability, etc. In the ISLM model, as the prices are assumed to be given, the expansionary monetary policy seeks to raise the aggregate demand and income. The effectiveness of monetary expansion is measured by the extent to which income rise in the economy. There are many factors which determine the effectiveness of the monetary policy to expand the level of income and output in the economy. Let us see the effects of expansionary monetary policy in the following situations. First, liquidity trap and monetary policy. Second, classical case and monetary policy. Third, lending behavior of banks. And fourth, slope of IS curve. Starting with liquidity trap and monetary policy. An economy is said to be in liquidity trap when the public is prepared to hold whatever amount of money at a given interest rate. It means that LM curve is horizontal and changes in monetary policy do not shift it and has no effect on interest rate and income. The situation of liquidity trap is the outcome of the Keynesian theory. Under liquidity trap, the interest rate in the economy is so low that with the increase in real balances, people cannot be induced to buy bonds which pay zero interest rate. In liquidity trap, LM curve is horizontal and monetary policy carried through open market operations do not change either interest rate or income. This implies that when economy is in liquidity trap, monetary policy is completely ineffective. A vertical LM curve implies that the demand for money is completely unresponsive to the changes in interest rate. The vertical LM is called as the classical case because the level of nominal income is solely determined by quantity of money. as the interest sensitivity, that is H, is 0, the LM equation turns out to be KY is equals to M by P or KYP is equals to M. This implies that the nominal GDP, that is Y into P, depends only on money supply, that is M. When LM curve is vertical, only monetary policy can affect the level of income in the economy. A monetary expansion leads to the increase in income and fall in the interest rate with no further adjustment in income, as goods market also attains equilibrium after the LM shifts. The vertical LM curve implies that the demand for money is not related to the interest rate, and there is a unique level of income at which money market is in equilibrium. It can be seen from figure that expansionary monetary policy has maximal effect on the equilibrium income and output. Then we have lending behavior of banks. For monetary policy to be effective, an important factor is the lending behavior of banks. When interest rates drop as a result of monetary expansion, this encourages investment spending by the firms in the economy because of lower cost of investment. For financing investment expenditures, firms approach banks. But it may be possible that banks may not be willing to lend due to prevalent pessimism in the market. If the banks will not lend, this will eliminate an important link in our monetary transmission mechanism. Thereby, it will significantly affect the investment and will not lead to the rise in the output. That is the reason why sometimes monetary expansion has only limited impact on the economy. Finally, the slope of IS curve. Another important factor on which the effectiveness of a monetary expansion in the ISLM model depends is the slope of IS curve. A steep IS implies that investment is not very sensitive to the changes in interest rate, so a larger increase in interest rate is required in order to raise the aggregate spending and income in the economy. Thus, steeper the IS curve, less expansionary the monetary policy will be. Let us now summarize what we have learnt in this module. First, ISLM model brings together the goods and money market to establish simultaneous equilibrium in both. Second, the objectives of monetary policy include price stability, economic growth, financial stability, etc. Third, in the ISLM model, expansionary monetary policy drives the interest rate down and national income up, while the contractionary monetary policy drives the interest rate up and national income down. Fourth, the LM curve shifts to the right when the money supply rises and shifts to the left when the money supply contracts. Fifth, the monetary transmission mechanism is the process by which changes in the monetary policy affect the aggregate demand and income level. Sixth, the monetary policy multiplier shows the effects of changes in the real money supply on the equilibrium level of income. It is given by change in Y0 divided by change in M by P is equals to gamma into B by H. Seventh, the monetary policy has its maximum effect on income and output when LM curve is vertical. Eighth, the extent of the expansion or contraction depends on the slope of the IS curve. The steeper the IS curve, the less effective are the monetary policy changes with respect to the income changes.